There are many things you'll find in common between the Forex market and the stock market. Now, both markets are considered speculative, which means that they offer you higher risks and higher rewards than other assets. Both are faster in their movements than other investments, and like many other investments, both of the markets grow as new online investment platforms emerge. Of course, that doesn't mean that both the markets mean the same thing, but you'll notice a surprising amount of overlap in their differences. It would be in your best interest to consult a financial advisor whether adding Forex to your investment portfolio would be a truly wise decision. Now, we've already discussed stocks in detail previously in the course. For a short recap, though, stocks are equities. When you buy a company's stock, you're buying a part of the ownership of that company. If you buy a share of Tesla, you literally own a part of Tesla. Large companies generally issue millions of shares of their stock, if not billions. So even if you buy just a share of that company, you will own 1/1,000,000th of the overall company. Forex, which is short for foreign exchanges. This is the market where you trade global currencies. The currency of all global economies trades at different rates against one another. For example, at one point in time, the dollar was worth 0.83 euros. In short, if you go to a bank and give them a dollar, you'll get 0.83 euros in exchange. On the contrary, if you give the bank 1 euro, you'll receive 1.21 US dollars in return. Now, these exchange rates, just like stocks in the stock market, keep changing based on changing rates of global demand. Let's say that the tourist or export sectors of an economy are both on the rise. Well, then its currency will also gain value since people will start looking for ways to buy things from that economy. If you plan to visit India, you'll need a rupee to spend on your stay, food, and other expenses. As more people go to India, the greater the demand for the rupee becomes. Similarly, investors try to find new opportunities in the market in different economies. Let's say that you're considering buying real estate in London, so you'll need pounds to execute the transaction. Meanwhile, banks have to keep reserves of different currencies from economies so that they can meet the needs and demands of investors, of savers, and of spenders. Now, the reason behind the currency fluctuation is really beyond the scope of this course, but the short answer is that the changing demand among economies is what flows. The profits that you make in a Forex are treated entirely as capital appreciation or gains. Your ultimate goal should be to sell the currency for more than you paid to buy them. And this is possible when the foreign currency you're holding gains more value than the currency in which you are doing your banking. An American investor would do all his or her banking and pay taxes in the US currency, the US dollar. So naturally, this currency becomes the mode of their trading. When an American investor buys a foreign currency, he or she will hope that the currency bought gains more value than the US dollar. In a nutshell, if you're investing in Forex, you are literally exchanging or trading one currency against another. Your goal is to hold a currency till it gains more value against the currency you want. The biggest similarity that you'll find between the stock and currency markets is really their role and contribution to your investment portfolio. Like we discussed before, both markets are considered speculative assets and come with high risks and high rewards. So, as an investor, you should assess all the factors and use the assets accordingly. There's a strong saying in the money market that you invest only what you can afford to lose. But of course, don't turn a blind eye to the potential for strong gains that you can make for yourself. Both stocks and Forex move at a rapid pace and much faster than other assets, with values changing continuously over the course of a day. But foreign currencies are considered a much faster market as against the stock market. As an investor, you can hold stocks for days or months, even years, but you'll hardly come across an investor who holds currencies for more than a few hours or days. And that's why currencies are considered more liquid as well as more volatile assets than stocks. Now, there's no doubt that investors make money in the long run, but it's difficult. At the same time, currencies are considered a much more complicated market than stocks. There are many factors which can affect the price of a currency to a point where it would seem like the market is really just moving at random. You would also need much more capital to start trading in the currency market. Most of the fluctuations in the currency market occur due to movements in pennies or even fractions of pennies. So you would need to invest vast amounts of money if you're looking to make meaningful and significant gains. Both the markets follow the general rule that the more you invest, the more room there is to make profits or losses. But currency market demands large upfront investments in order for you to really start trading. The Forex market might not be the best option for you if you are a novice or a retail investor. This market is very technical and difficult to understand at times. Moreover, the Forex market also carries a very high risk. It's possible that you might lose thousands of dollars in a matter of just a few hours. Of course, there's nothing wrong with trading in this market if you have money that you can afford to lose, but you need to assess the situation very carefully before investing a significant portion of your portfolio. So, as we know now, Forex is a decentralized global market for foreign currencies where traders can buy or sell a currency for another currency. Forex is a floating rate market which operates 24/7, making international trade much more efficient. At the same time, it's much more complicated and volatile than other markets such as the stock and bond markets. It can be said that the Forex market affects all American stock and bond investors due to the fact that the U.S. securities are denominated in dollars, which is a currency itself. Then we have penny stocks and Forex trading. Penny stocks and Forex trading is for those investors who plan to trade with limited investment capital. You'll find relevant opportunities in either investment market to make a fortune for yourself within a matter of a few years with just a small amount of capital. If nothing else, you'll always have a window open to get into investing with a little bit of money. On the contrary, you'll need significant capital to invest in regular stock trading to see substantial returns. If you're investing with a capital of $1 million or even $500,000, you would be able to earn a decent sum of money even with a 10% return. But take an example of a person who can only invest $500 or $1,000. Well, a 10% return on this investment won't be enough even to cover the cost of a new smartphone. If you're investing in regular stocks, there's no doubt that you would get decent returns on your investments, but you won't find the explosive growth potential that is present in penny stocks or the high degree of leverage that you'll find in the Forex market. That brings us to the speculation market. Now, penny stocks are often associated with the speculation market, and for the right reasons. These stocks are for you if you're working with limited funds and if you're comfortable with speculative and high-risk investments. Moreover, if you're investing in penny stocks, then you should have the time and the inclination to do the required research, which is a must if you want to be successful in penny stock trading. Now, even though penny stocks are considered those stocks that are traded under a share price of $5, which includes many stocks that are traded regularly on exchanges such as the NASDAQ, a majority of people consider penny stocks as those low-priced stocks which are traded through over-the-counter bulletin boards, or more commonly known as pink sheets markets. What sets penny stocks apart from higher-priced stocks that are listed on trading exchanges is that you want to be successful in trading penny stocks, so you would be required to put in significantly more time to obtain the latest and reliable information about the companies in which you plan to invest, and assess that information thoroughly. Securities and Exchange Commission, the SEC, doesn't require pink sheet stocks to register with them and is not very strict in regulating the public information which pink sheet traded stocks are required to provide. Moreover, penny stocks are often sold with less than accurate information. And that's why, in order for you to be a good penny stock investor, you must spend extra time and effort trying to obtain good and relevant information which will help you make good investment decisions. Day trading versus swing trading. All right, so let's talk about the differences between swing trading. Although these are similar methods, there are a few differences that you really do need to keep in mind. The key difference between these two methods is the frequency at which you make the trade. Whatever your method to employ, you can make gains, but it also depends on the amount of capital that you're deploying, the amount of time you're giving, your trading psychology, and last but not least, the market in which you are trading. So, let's talk about the 5 key differences which might help you decide whether you want to be a swing trader or a day trader. First up is trading frequency. If you get into day trading, you'll open and close multiple positions in a day. On the contrary, swing traders open positions which can last for days or weeks, even some cases, they can last for months. Then you have the number of transactions. Swing traders make multiple trades which can keep going on for days or for weeks or for months. So although swing traders make gains or losses, they accumulate it all really slowly compared to day traders. Although certain swings can work out in your favor and can result in big gains or losses. Let's say you're a trader who risks 40 to 50% of capital on every trade and makes 1 to 2% on your winning trades. Let's then assume that you're earning an average of 1.5% on your winning trades and losing only 0.5% on those losing trades. Let's further assume that you're making 6 trades a month and you're winning in half of those trades. With these numbers, you can make around 3% on your account balance in a month, and the total comes out to about 36% over a year. Now this sounds good, but overall, it has less potential than a day trader can earn than a swing trader. Day traders look for quick money and are continuously on the lookout for rapid compounding of returns. As you can figure out from the name itself, day trading simply means that traders buy and sell a security on the same day and often multiple times a day. Typically, day trading offers more potential for profit earning than a swing trade does. Well, at least on smaller accounts. Day traders usually follow the 1% risk rule. According to this rule, you should not risk more than 1% of your portfolio on any single trade. Again, let's play the assumption game here. Let's say that you are a day trader who risks on each trade 0.5% of your capital. If you win, you'll make a profit of 1%. If you lose, you'll lose 0.5% of your capital. So that gives you a reward to risk ratio of 2 to 1. Let's assume then that you win 50% of your trades. You're making 6 trades each day on average, so you'll be adding around 1.5% to your capital every day, less trading fees. So even if you make 1% a day, your account will grow by more than 20% in a year, uncompounded. Let's talk about time horizons. Swing trading is all about strategy, where you assess the situation and make trades which can last for days or for weeks or for months. Your goal as a swing trader is to make short-term or medium-term profits according to changes in trends in the market. On the other hand, day trading involves taking multiple positions on 1 or 2 trading days and gathering as many small profits as you can as the daily price of a specific security changes. Time required. So it really doesn't matter what kind of a trader you are. Both swing and day trading takes time. Between the two, day trading can take much more time. Usually, day traders trade for around 2 hours every day, but there are other factors that you have to be considerate of well. And you have to prepare and review charts and trading, which means that you have to spend at least 3 to 4 hours at your computer. As you start spending more time on trading every day, your time investment goes up, and soon it becomes like a full-time job. Of course, both types of trading demand a lot of time from you. As a swing trader, you have to do more research, and as a day trader, you have to do more trading. Pretty simple stuff. As a swing trader, you have much less active trading time. If you're swing trading off a daily chart, there is a possibility of you finding new trades, and then you can update orders on your current positions in about 30 to 45 minutes a night. Moreover, you might not even have to execute these activities every single night. If you enter a trade that goes on for weeks or months, then you just need to look for trades and update your orders once a week, which brings your total time down to about an hour per week, as opposed to an hour per night. How you trade. As we've seen, the time horizons are much longer in swing trading. So as a swing trader, you can open and use your online brokerage account to create positions and start trading. Swing trades are not under a lot of time pressure, and they don't need to act and make decisions within seconds of a price change. If you're looking to get into swing trading, you'll first have to open and fund an account with a brokerage. Once you're done adding funds, you can start trading on that brokerage's platform. On the other hand, day traders require the most updated software and technology at any point in time to really make the most out of their trading activity. Prices change in the blink of an eye and can change before you can even decide to enter a trade. So it goes without saying that automation is absolutely necessary for you to make profitable trades. To start your day trading journey, you need to set up your account with a broker first and get access to a computer system and software with the help of which you can access all the information when you need to make a decision. So, which is right for you? You'll require a lot of knowledge, and you'll have to put in a great amount of work to make good profits for yourself consistently, be it day trading or swing trading. You don't have to be book smart to generate profits for yourself. All successful traders have one thing in common. They make a strategy for themselves which produces results and profits over a significant number of trades. The next step is that you have to be consistent in executing that strategy. So, before you begin your trading journey, you can take advantage of what is called paper trading. Paper trading is a simulation where you make hypothetical trades, but assume that you were trading real funds. If you want good and consistent results, then put yourself under different market scenarios and make a strategy accordingly. There's no doubt that this whole process takes a lot of time and involves making hundreds, even thousands of trades. But ultimately, all this practice will make you a better trader. Find a broker which offers you a paper trading demo account for free so you can learn from the platform and practice your strategies properly before taking a step into the real market. There are a couple of things that you need to keep in mind when you decide which type of trading suits your lifestyle. One of the big issues is stress. You will experience more stress in day trading than in swing trading. On the positive side, you'll know your stress tolerance and you might even improve it. Then we come to pace. Now, swing trading involves trades which can last for days or weeks or months, like I've mentioned. However, the pace can be really rapid in day trading. Then you have to focus. You will require observation skills and a constant focus for extended periods in day trading. And that's because of the rapid pace and short windows of opportunity in which you have to make quick decisions. Of course, that doesn't mean that swing trading doesn't require focus, because it does. But there are long periods in swing trading between actions, like entering or exiting trades. Then we talk about freedom. Since swing trading takes less time than day trading, one might argue that swing traders have more freedom in this aspect anyway. If you get into swing trading, you'll need to employ both fundamental and technical analysis to pick stocks. Fundamentally, you would want to pick those stocks which exhibit specific traits that will match the position that you're getting into. For example, you would prefer strong earnings, a healthy balance sheet, and a reasonably priced valuation for a buy position. For technical analysis, you can take the help of support and resistance levels, along with indicators that show momentum and volume, which help identify profitable opportunities. Day trading is more about the price changes of the security you're trading than about the type of the security itself. You can use volume and momentum indicators, which will help you determine when you can enter or exit one of your trades quickly. If you are into day trading, then the technical analysis is an absolute must, because it will help you spot trends in prices as they occur. We do need to talk about capital requirements. The amount of capital you need to begin your swing or day trading has more to do with what you're planning to trade than how you will trade. Different categories like Forex, stocks, and futures have different capital requirements. What type of trading you choose also depends on your personality and your preferences. Let's go back to Forex for a moment. Now, the amount of capital required to trade differs according to the market you're trading, as we've mentioned. Although no legal minimum exists if you want to day trade in the Forex market, your broker still might ask you to maintain some amount of capital in your account consistently. It's generally considered good practice to start with $500, but $1,000 or more is better if you want to enter multiple trades. Switching to stocks. Now, if you're planning to day trade stocks in the US, you need to maintain an account balance of at least $25,000. Once again, there's no legal minimum amount that exists to swing trade stocks, but your broker might require you to maintain a minimum amount in your account anyway. If you want to generate an income from swing trading, you'll want to build up and hold at least $10,000 in your account, preferably $20,000. It's good practice to have $1,500 on hand for swing trading. You'll be able to enter at least a couple of trades with this amount of capital. So what's the bottom line? Both types of trading differ in their own respective ways and have different needs and different styles. One isn't better than the other, though day trading does hold more potential for profit generation given the higher frequency of trading. That being said, swing traders still have plenty of potential for profit too. Similarly, capital requirements vary according to trading styles and different markets. Both types of trading require you to practice regularly to get consistent, although day trading needs more time than swing trading. If action and risk is your forte, then you should consider day trading. On the other hand, if you're looking for a low stress and less time-consuming option, you should consider getting into swing trading. How confirmations on a chart work. One of the many indicators followed by technical analysts is confirmation on charts. These analysts mostly focus on chart trends, and they're really less interested in stock fundamentals like company sales and operating margins. There are often times when traders will chart several indicators simultaneously in order to provide as much data as possible in the process of considering whether to buy or sell a stock. It's believed to be quite common, actually, for technical traders to look for confirmation on a chart from 3 charts to support their convictions. We can tell that technical investing through the use of charts is all about understanding and detecting patterns. Once we're able to visualize and name a pattern, it becomes possible for us to look back over many years and determine how effective that particular pattern has been in determining quantifiable trends. It's frequently observed that what appears to be a chart pattern is actually just more sideways movement within an ongoing trading zone, meaning no particular direction has really been realized. Finally, confirmation on a chart occurs when the predicted movement actually plays out. The lexicon of chart pattern names is extensive, with a substantial variety of entertaining names that range from abandoned babies to dark clouds. Each of these patterns has a shape that can be distinguished. While dealing with this, it's important to keep a general rule in mind. Being patient and waiting until price confirms a pattern or a thrusting move is validated by follow-through does pay off. In the long run, being patient will help increase your discipline. So the key to remember here is this. Trading is a marathon, not a sprint. It's advised to patiently wait before entering a trade, meaning there's no guessing involved. It's expected to simply act and position according to what the price is telling traders to do. Now, we must be careful of the fact that being patient and being too late often are very closely related. The best investors and traders understand with regard to the importance of patience, although it is one of the most difficult skills to learn as an investor and a trader. When we're dealing with the principles of trading, the decisions concerned with when to buy a stock can sometimes be easier than knowing when is the appropriate time to sell a stock. Patience and discipline are the 2 significant virtues which will benefit all traders, keeping all emotions and snap judgments in check. Due diligence and quality research should inform your decisions about when to get in and out of trades, and allowing the price to catch up with the fundamentals. We know that can take some time. Another skill investors should focus on is identifying exit points to limit downside losses and take profits before those opportunities completely disappear. Let's talk quickly about waiting for your entry point. Consider that an investor has successfully identified the entry point for a really promising stock. All that's required is to wait in anticipation for the price to reach the particular entry point. Instead of pulling back, the price lunges upward. There's panic, entering an order above a planned entry point in a rush to ensure the trade isn't missed out on. Well, by doing this, the person gives up some of their potential profit. But more importantly, they actually violate the rules that caused the person to enter the trade in the first place. It is necessary for investors never to let one's emotions rule the day, knowing that it can often lead to disappointing returns. In fact, impatient investors who violate their discipline may be headed down the path to ruin. Following a predetermined set of rules keeps the emotional side of trading and investing at bay. Fishing for a winner. Drawing upon an analogy, patient investing is similar to fishing. There are many fish in the sea, and it isn't necessary to catch every fish which swims by in order to be successful. In fact, it's only necessary to catch those few which bite and fill up one's nest or which meet one's trading criteria. It is to be kept in mind that there are always many trading opportunities in the market, even in a tough market. So the difficulty is not so much in finding trading opportunities, but making sure that the opportunities fit your trading rules. It's vital to get good entry points and make sure to have defined exit points and stop losses without having to get in on every trade. If the stock doesn't want to bite or fails to meet the criteria, don't worry about it. Be patient. There will likely be another fish or another opportunity right around the corner. If an investor feels a loss of control entering a stock before its time, it's usually best to exit the trade and wait for it to develop based on predefined rules and not governed by one's emotions. Take the costs associated with the trade as a lesson, learning from it, and finally, moving on. Waiting for the right entry point is an essential characteristic of every successful trader. If a trader feels tempted to enter an order before its time, he or she would step away and go over the reasons that the person selected the entry point again. This will act as a reminder to abide by the discipline, which will eventually contribute to your success. So, knowing when to sell a position. Oftentimes, even after a trader has managed to follow through with the discipline, despite being patient, it's natural that the price of a stock barely moves. Let's discuss what the right steps are to take in this particular situation. In most cases, it is best to go back and re-examine the analysis of this trade. Take a fresh look and try to find what's changed. If something is different, does a new analysis change the original reason for entering the trade? If the rationale for the trade has changed, does the analysis call for it to avoid the stock at this price? Going by these questions, a trader can assess whether or not they should possess this stock, which is then sold immediately. On the other hand, if the analysis indicates that this stock meets all the set criteria to own and the entry point is very close, it makes sense to continue holding the position. In many cases, the price of one stock will approach the target and being patient will work out well. Now comes the time when the position is to be closed. One can continue to be patient, waiting until the price hits the target or the trailing stop. Other than that, it's also acceptable to tighten up your stop to ensure a profit on the trade. In either case, it's time to reward one's patience with a profitable trade. With a little more discretion provided in selling, it's easy to make changes to targets and stops based on some predetermined criteria. For example, a person may decide that when a trade gets halfway between the entry and the target, they'll adjust the stop to the entry price.